this video, we'll be talking about the risk to the inflation narrative. These are the topics we'll be going over today. Apologies for the lack of upload. I've been a lot of excuses. Been busy with tax season and as an accountant, and just been lazy. Again, none of these are investment advice. These are just my personal opinion, so please do your own research. First off, let's talk about the executive summary. So I'll point out some risks to the inflation narrative and how I think the commodities reflation trade might be over, with taking a look at the leader, like most impressively lumber, corn, maybe copper as well. Since I don't think this is the super cycle where it's supply that's really driving the price increase. Next up, we'll talk about how inflation expectation, how that's different than actual inflation, and what happens when it runs ahead of actual inflation. And finally, we'll take a look at some future outlook. First, let's take a look at commodities. So we've already seen quite impressive rally for many, like for industrial, like lithium, copper, iron ore, agriculture, like lumber. That's what a lot of people talk about. Corn, soybean, and wheat. So a lot of these are from overflowing liquidity with some supply constraint and also the restart of the economy. So where that comes, like let's say for example, like a mine couldn't be in operational in early days, and that has an impact on the storage of that material. And what happens is, as economies stop like shutting down, like a lot of countries reopen, there were a lot of demand in terms of whatever goods that people want. And that's kind of what happens in terms of the reflation trade. But I think what we're starting to see, or at least we're seeing, is the cobweb model, where, for example, for corn, soybean, a lot of farmers now are purchasing or increasing their planting of corn and soybean as a result of the much higher prices. And because of that, what we'll see is, with the rise in price, it will cause higher supply. So we're starting this cobweb section, and we're going this way. And what's happening is the suppliers, with the increased supply, they can now come into the futures market, which is majority where the prices is being driven up, that they're able to sell longer term futures contract now, and that will start pulling down the whole COMEX market. And that's kind of what we're starting to see with these commodities, is because they are able to increase that production, and the demand is not like increasing, it was just returning to a previous normal level. Obviously it's not there yet, but because it's not like an increasing demand or a real like shrinkage in supply where they can, with time, like there's enough time now that supply can catch up, and the suppliers are coming in now to start selling futures at these much higher prices. And that's why I don't think this is really it for the commodity super cycle that could happen, where it's because of many years of lack of capital infrastructure that is causing a supply shortage. Like for example, like a mine, where imagine having a mine, you need consistent annual capital expenditure to either find a new deposit or continue developing the mine. And without that, once you mined out whatever you had available or prepared, then the supply goes down. And I think that part we haven't really seen yet. Next up, let's talk about the crypto mania. So again, I I think this is the peak of speculative mania. As mentioned before, I see them as like a Ponzi scheme because they're not income producing asset, nor are they a commodity where it has actual uses. So, short summary, like you can watch that video if you want for more details. It's a small amount of players controlling the whole market on both short and long end. And I keep watching the 5-minute charts. It goes up and down so much. It's very volatile, and what happens is because the small players can control the market, because they have a lot of coins, they can, run down the short end and then run back up the long end in a very short amount of time. And because it's not regulated, that they can just do that. They can't do that in like any of the actually regulated markets, so they can do it here. And what happens is they make a lot of money on both ends. And what we're seeing now is the second part, where if one coin gets really popular, where the public is buying a lot, or they're done with it, whatever reason, they can now sell their parts. They don't have to sell all of it, but they sell some enough that now they can play in the next coin. So what we're seeing, like for example, Bitcoin obviously was the first one, and now Ethereum, Ripple, and even Dogecoin, who was, it was made as a meme to Bitcoin. It has like similar properties. Obviously, it has the difference being like hash rate and quantity limitation, etc. But it was created as a meme, and the original creators, they were done with it from like 2015, saying they sold everything and they just bought a Honda. But that is picking up because Elon Musk, tweet about it saying like, oh, that's the future, or to the moon, and then he comes on later saying, I think on SNL, saying like, oh no, it's nothing. Like there's a lot of pump and dump in that, and this can happen for crypto because they're all so replaceable. They can substitute for each other with, again, minor difference in hash rate and quantity limitation. So you have thousands of coins that can easily replace each other. And so it doesn't matter what you buy, they have full control of whatever it is on both long and short side. And then if you get too much of that coin, they just move to another and leave you with this one. So the only way to not get hurt in this type of market is not participate. So now let's talk about inflation expectation. So as prices are rising in some necessities like crude oil, more and more people are joining the talk of inflation. So now that's when we're starting to see higher inflation expectation. But if we actually take a look at the details, like for the PPI, it's actually rising a lot quicker than CPI, meaning the upper end of the supply chain is actually feeling the pressure hot more than the lower end. They're either not able to, or they're unwilling to pass it on all the way through, or maybe it's a lagging impact. But it is also possible that some aspects are not fully reflected in the CPI. It's kind of flawed in this aspect where, for example, like we saw Costco downsizing some of their packaging. That's not really reflected in the CPI because the price doesn't change, but they're downsizing the amount that you can buy. Now, one key financial aspect for inflation expectation is as inflation expectation ramps up, it drives nominal rates, because as investors are like, hey, I'm expecting inflation to be X amount in a year. I want a higher return from, like, for example, like more so fixed income and then equities. I want higher returns because I know X amount would be inflated away. And if inflation expectation runs ahead of actual inflation, what happens is it drives the nominal rate higher than actual inflation rate, and then real rates become positive. And this has negative impact on commodities, especially those with a and other financial assets, um, and but especially for those who have majority financial monetary aspect, and for example like gold, because it yields zero. So it makes a lot more sense when real yields are like, let's say, -1%, then it's better to hold gold because it yields zero. But if real yields are like +1%, then the opportunity cost to own gold is now higher. So now let's talk about the equities market. So we have seen the Taiwan market pullback. Um, this is from a combination of news where there's COVID cases increasing. There's also a lack of water that doesn't help with for example Taiwan Semiconductor, where that's one of the reasons we're seeing a computer chip shortage, which is driving um, a lot of other areas. For example, like a lot of cars aren't able, like nowadays, have computer chips in them, and they can't be finished without those chips, and that's also driving up the secondary um, second-hand car market. And then there's also some foreign investor shorting that we're seeing from um, the derivative side. And with the US market, now we have already seen a bit of a decline from start of May. It's possible that it's from the seasonality, sell in May and go away, or the good earnings are just not sufficient enough to push the prices higher because investors have already priced in and front ran that news. And so even as they're beating expectation, it's just not enough to push the price higher. Like, investors aren't willing to pay an even higher premium for it. And if we do see higher yields, that will put more pressure, higher pressure on valuation. It's already ridiculous the way they are, but it can get even crazier. But eventually, it does come in because someone's gonna break the line, and they're gonna sell, and then it push. And unless you have more and more and more people putting in more and more and more money to pump up the price, it eventually comes down. Now let's take a look at the Fed's goal. So they say their focus, their mandate is two things, which is stable prices, which they identified as 2% annual. It was like average price increase, and employment. Now, the truth is that they really only control one thing, the US dollar. And as a consequence, it's global status, because that's the only thing they can control, which is the money supply of US dollar. I mean, they can use it to buy things, but the one thing they can create out of thin air or reduce is US dollar, but looks like they're only creating. The US dollar index is actually has bounced quite nicely around 90 after it's run to 93. If it doesn't break below 90 and its previous low of 89, and if it continues its rally up, then it would put further pressure on commodities. And I think the Fed's goal is to make sure it maintains that US dollar price, but I could be wrong. So some market participants are actually betting on a July to August timeline for the Fed to start talking about maybe not so much like rate hike, probably not this year, but they might start talking about it, saying, oh, this can happen. Like, we have already seen Treasury Secretary Yellen coming out, like trying to test the market, like in the morning, saying like, oh, a rate hike wouldn't be a bad idea. And then with like really stress testing the market, and the market threw a tantrum, like, oh no, we don't like this. And there's a bit of sell-off. So immediately in the afternoon, she comes back in saying, oh no, that won't happen for a while, so don't worry. So, it's kind of funny. And then with the Fed potentially starting to talk rate hikes and QE reduction as well. So those are the things we have to watch. So it's possible that inflation is high now, but not long lasting. So that's the key. If they do continue printing, then we're all good. That's the inflation narrative runs on. But if they don't, then that's where it's possible that this rally is over for the short run until a later time. And next slide we'll talk about why potentially one of the reasons why they'll also come in, not just because of the US dollar. So one of the reasons why I think the Fed has to act is China's deleveraging. So as mentioned before, China is taking the opportunity to deleverage, and this is a golden window. And where's that coming from? So there's the overflowing liquidity from US, massive printing. And what happens is once money get to the hands of, the citizens, they're buying a lot of stuff, right? Where are these things coming from? Because they're not working. A lot of them are not working. Well, a lot of it is coming from China. So we're seeing the expanding trade surpluses from China to not only US, but Europe as well. And it helped its recovery from the pandemic because obviously they were the first one to shut down as COVID happened there. But the key point here is Bank of China is not allowing credit to loosen as economic activity returns. And so we're seeing default rates quite high for example, the corporate bond market, I think it's 12%. But I might be wrong on that. But the problem is the yields in comparative are high enough in comparison to other countries because they're holding yields lower. And with liquidity overflowing, people are willing to pay or not and buy up these corporate bonds and take that default risk. And so what happens is the financial assets prices are not being impacted as much. So this is why it's the golden window, because they can allow for these companies and citizens to deleverage the whole default cycle without having too much impact on the financial asset prices, because one, yield is higher in comparative to other areas, and two, there's a lot of money just searching for yields. But I guess that kind of leads back to the first point. And the idea is, as China is able to get out of this and able to restructure its capital structure, the question is then, how much longer will the Fed allow this to happen? Obviously, the Fed is being put in a difficult spot because if they try to counteract this, then they risk a correction on the financial asset side on their end. But if they don't, then China will come out stronger, much stronger after they deleverage. So that's why I think potentially around July and August, that's where we'll see the timeline of Fed trying to come out to try to slow down their QE, potentially talk about rate hikes. So finally, let's talk about some outlook. So with the Fed narrative, so again, July and August, that would be the kind of key watching point in terms of first sign of them talking about tapering and rate hikes. Currently in May, we should watch for the US market general correction where we saw a double top in NASDAQ. Level to watch would be 13,000. Dow and S&P has been relatively stronger because of the trade from growth to value. Gold, it's slowly moving up, as mentioned. It looked like the bottom is in at 1680, and it looks like it made a double bottom quite nicely. Past 1800, the next level being 1850, support at 1750. The short-term risk is both general market correction, the inflation narrative no longer going on for the long term, meaning if Fed comes in to start tapering. So other than those, then if gold is continuously slowly moving up, then we could see a new all-time high this year. But again, watch for those risks. Uranium is quite interesting. More market players are attempting to squeeze the physical market. This includes producers like the big ones like Chemico, Kazatomprom, and other smaller ones as well, like Denison Mine. And what Sprott Inc. is coming in, like I guess the first non-producer, I might be wrong on that, market participant. So they're going through Uranium Participation Corp, entity that buys and hold uranium and then sells it when the NAV is with spot price is at a much favorable price. And what they're trying to do is potentially take over that entity and try to get more funding from the New York Stock Exchange. And if they're able to do that, this market is so tight that we can see a quite explosive move. So until they get, obviously, and more short-term risk is general market correction. So we could see a very nice entry point before they're able to get that going in terms of institutional investors, and this could be like hedge funds having like an interest buying, helping to short this market as well, like short squeeze this market as well. And finally, oil, very political, so really hard to gauge, but potentially an Iran deal before the next election in Iran. Waiting to see if they will ramp up their production. So right now, I think the opposition party is having a lot of like recent activity, like they're drawing a lot of attention. So they need a win, and something that Biden can do is make them a deal, say like, oh, we made this, and it also gives them bargaining chips against Russia. So we'll see how that goes.